Hello and welcome. I'm Woody Whitcomb with PCE Investment Bankers, and I'm joined by my colleague, David Jasmund.
Hey, Woody. Great to be with you here today.
Thank you for joining us today. We're going to take you through a discussion on the latest topic from our webinar series, Navigating Your Business Through Uncertain Times. Today's discussion is the third in the series. Some of you might have attended the previous discussions called How to Survive Your Bank Debt and How to Achieve Growth Through Acquisitions in a Challenging Environment. If not, they're available on our YouTube channel. Today's topic is titled, Yes, You Can Still Sell Your Business. Many business owners out there will be understandably confused and concerned given the current crisis environment about whether there is going to still be a market for their business once we come out on the other side of this pandemic crisis. And we intend to address those concerns today. Well, we've obviously led with our close by the title of this webinar. And some of you might say, well, you're investment bankers, so of course you would tell me that I can sell my business. But we understand the thought process there, but the fact is that we've spent the past month or so surveying the markets, and we feel like we have a pretty good feel for the landscape. But things will be different, though. And with that said, let's move forward into our presentation. So during recent discussions with business owners, several have expressed concern over whether there will be a legitimate market if they choose to sell their business in the near term. So our answer is yes, you can still sell your business. There will still be motivated buyers in the marketplace. The deals will still get done. Without question, the deal-making environment will be more challenging, though, because there is considerable uncertainty about the near-term future and how long it will take for business to recover from this crisis. This uncertainty is further complicated by supply chain disruptions that add extra layers to business recovery plans, and unfortunately, we should expect considerable business failures among businesses that do not have the resources to outlast the challenges ahead. With these factors in mind, it's critical that business owners focus on their businesses today and their people. As the crisis subsides and the economy reopens, there will likely be a flood of deal-making opportunities, and those best prepared in protected businesses will stand to benefit. We expect deal capital will still be abundant. Last year was a record year for fundraising by private equity, and according to the latest McKinsey Global Private Markets Review, there's still $2.1 trillion of dry powder or unallocated capital that is looking for a home. As a result, deal-making interest remains strong. One aspect of the deal-making environment that we do believe will be altered will be the makeup or profile of the market, and it will be interesting to observe how this unfolds. Traditionally, the majority of M&A deals are strategic in nature and between two companies. Given the damage caused by this crisis, though, we believe that it may take some time for many strategic acquirers to regain their bearings and assess their futures. As a result, the pool of strategic acquirers poised for a near-term transaction is probably going to be shallower. Financial buyers, on the other hand, have an investor mandate to find more deals, so their post-crisis response will not be to shut down, but instead to employ creativity to close deals. So for those business owners who desire to sell once the economy reopens, we believe that there are and will be buyers. So David, perhaps you might walk us through the options available to business owners, buyer options that is, who are interested in selling?
That'd be great. Thanks, Woody. So, yes, business owners really have multiple, as we all know, multiple succession options. The most commonly options really are displayed here: strategic acquirers, financial buyers, or investors, including private equity and family office type investors, and employee stock ownership or ESOP plans. Of course, three other strategies not displayed here, are still available and have been available, and that is a management buyout or MBO, a leverage recapitalization of the business, and of course IPOs. Are three other options. They're still available today, but even in the best of markets, IPOs are really an alternative for very few businesses, as you really need to be a business where your value is approaching $500 million and can grow for an IPO really to make sense. And of course, MBOs and leverage recaps are done slowly over time, utilizing the future after-tax earnings of a business to fund the acquisition of an owner's shares. And there, that's a strategy. Those are strategies usually retained and utilized when you're trying to acquire or sell a limited percentage of your ownership and provide liquidity to yourself. So let's spend a little time talking about the three strategies listed here, starting with strategic acquirers. So, the vast majority of M&A is and really always has been performed and created by strategic buyers. I read recently in an article that 80% of M&A transactions involve buyers that are operators of other businesses. And in fact, Woody is next going to speak to financial buyers. And another article I read, or perhaps it was maybe the same article, said 75% of private equity deals are their portfolio companies buying other operating businesses. We all have read a lot about M&A over the last 5 to 10 years, the past 5+ years. Corporate balance sheets and cash on those balance sheets, as well as easy access to inexpensive debt, has really been the driving engine of M&A. Of course, the motivation of a strategic buyer is the growth of the business to expand new geographies or products and or services. And as a result, strategic acquirers approach M&A and usually very focused and lasered on looking for acquisitions to fuel growth and enhance earnings of the buyer's existing business operations. So with that, Woody, why don't you give us an overview of what financial buyers?
Yeah, sure, David. So financial buyers, first of all, let's define what is a financial buyer and then discuss briefly the various types. Financial buyers are really investment vehicles formed to invest in operating businesses, usually for a targeted period of time and expected to deliver desired returns to investors. The sources of money are normally high net worth individuals or institutions such as endowments and pension funds looking to diversify their investment portfolios beyond publicly traded stocks and bonds. When I think of financial buyers, I group them into three general categories: venture capital funds, family offices, and private equity funds. So let's quickly discuss these three types of financial buyers. Venture capital funds, their focus is usually on investing in startups or early-stage companies, either pre-revenue or businesses which are not yet generating profits. The second are family offices. You might think of family office investors as high net worth individuals and their families interested in buying or investing in privately owned, successful operating businesses. These buyers have really emerged over the past few years as much more active investors or buyers. They are much like private equity funds, who I'll talk about next. However, family offices usually invest for a much longer horizon and are generally viewed as long-term investors in a business. They're identical to private equity in that they usually don't want to run your business, and they'll look for companies with seasoned committed management teams who have a business plan and vision to grow the business over time. Family office investors are focused not only on the growth in the value of your business, but many times we see them interested in buying other businesses that will be able to create a steady stream of cash that can be paid to the family office. And then lastly, private equity funds have become perhaps most well-known or most talked about financial buyer in the past 10 to 15 years. There's thousands of private equity firms active in today's market, invested in over 8,000 individual companies. I recently read that it is estimated that private equity, or I'll refer to them from now on as PE, that PE firms are looking to invest between $1.5 and $2 trillion of capital in operating businesses. Obviously, PE is a buyer any seller should pay attention to, but it's important to understand their investment strategies and goals. To best understand what PE buyers look for, let's start with how they're structured and the sources of their money. PE firms are usually created by a general partnership that manages the fund. They're staffed by individuals experienced in buying and investing in businesses. They usually have experience in certain industries and often recruit prior owners or CEOs of successful businesses in industries their fund plans to target. Their goal is to invest in a business, and allow that business to continue to be managed by the people running it, and to assist the company in recruiting additional management, investing in new facilities, technologies, or improved processes, all geared toward increasing the rate of growth in earnings. In addition to fueling this organic growth, the PE firm will assist in growing through acquisition as a strategic buyer, such as what David just described. Since PE firms don't actively manage the businesses they invest in, they usually will not buy 100% of your business, and they'll expect you and perhaps your senior management team to continue to be invested in your business, providing only partial liquidity for your ownership. Most funds will also require voting control in their investments, and pretty much all the time they'll require board seats. That should be expected even in minority investments. Finally, since most PE buyers will require you to continue to be invested in your business, it's important to understand what you as a seller to PE might expect from the PE buyer. PE firms are funded by limited partners or investors that provide capital to the general partners to invest usually for a specific period of time. You'll hear PE firms talk about the life of their fund. For example, in a 10-year fund, the LPs commit their money to the PE fund to use and invest for a 10-year period, and then they expect their invested money to come back to them with a return of profit at the end of those 10 years. Therefore, it's common for PE firms to buy or invest in operating businesses in the first 5 years of the fund, help their portfolio company management teams grow the business, and then sell them in the last 5 years of the fund's 10-year life. As a result, the PE buyer will expect you and your management team to have a vision and plan to grow your business in a specific manner and time period. You'll be reinvesting part of today's value in your business back into your business as a partner with the PE firm. And if you can continue to grow your business, you'll benefit from that growth. So while there's understandably a certain comfort in a more straightforward strategic sale for an owner, there is considerably more opportunity for future value by selling to a financial buyer. Financial acquirers often tempt owners with back-end riches for the sellers, and sometimes that works. However, you must be ready and prepared to remain engaged in the operations of your business and confident that in the longer time frame, your business growth forecasts are sound and you'll grow the value of your business. The biggest challenge in a financial buyer transaction, though, is finding the right one. As I mentioned earlier, there are thousands to choose from in all shapes and sizes. It's important to thoroughly research the market, get to know your future business partners, check references, make sure their goals are aligned with yours, and so forth. There are plenty of great financial buyers out there, but the challenge is to find the one that is a right fit for you and your business. David, I want to bring you in at this point because there's another type of financial buyer that I've not touched on, the ESOP buyer. Maybe you could kind of take us through that.
Yeah, great, Woody. I'd be happy to. So an ESOP is more like a financial buyer than a strategic buyer in that the ESOP is not going to make an acquisition as an opportunity to merge it into an existing business, maybe consolidate operations and staff, cutting expenses, reducing expenses, and creating new synergistic revenue opportunities. Therefore, much like a financial buyer, the ESOP will pay fair market value, but not the premium that a strategic buyer might be able to pay in buying your company. So what actually is an ESOP trust? So an ESOP is a formal qualified retirement plan for the employees and a tax-advantaged way to sell a business for its shareholders. For the employees, it is a gift, and they do not come out of pocket with cash to buy the company. Shares are actually held by the trust for the benefit of the employees on a tax-deferred basis. And much like a 401k, benefits are not taxed until the employee retires and takes money out of their ESOP retirement account after leaving the company. For the shareholders, it is a tax-advantaged way to sell your business, much like so most strategic buyers and financial buyers will actually buy the assets of your business, not the stock. An ESOP trust must buy the stock. That's all they can buy. So worst case scenario, when an ESOP buys your ownership in your business, you were looking at capital gains. And actually, under one ESOP type of transaction, you can actually structure the transaction to sell your stock, and the gain on the sale of your stock can be deferred and structured to pass to your estate at a stepped-up basis and never pay tax on the gain from the sale of your business to an ESOP trust. So the dollars to acquire the stock purchased by the ESOP trust come from the pre-tax earnings of the business. Most ESOP-owned companies do not pay federal income tax on their earnings, nor do they pay state income tax. Therefore, the company's cash flows flow through to acquire the shares from the non-ESOP shareholders. The ESOPs also are very flexible buyers, and they're happy to own a majority of the company, maybe even 100% of the company, or a minority part of the company. Woody, now that we've reviewed the three most likely acquirers of a business, shall we discuss some time discussing what we expect buyer types to change over the next coming months as a result of the COVID pandemic?
Yeah, David. Obviously, we're in a unique situation here, and nobody knows exactly what's going to happen when we get on the other side of the crisis. But we do have some expectations, and so I'll take a couple minutes to discuss what we expect the pandemic crisis to have on M&A activity. First, let's start by separating the conversation into the effects on M&A for two types of categories of business, which are essential and non-essential types of businesses. I think it's important, as we expect M&A activity and the way buyers approach targets, to be different depending on the effect the pandemic has had on different types of businesses within various industries. So think for a moment, for example, of the difference in the food industry between a restaurant and a grocery store. Both are in the same industry, but revenues and sales dramatically differed over the past 2 months. So let's start by discussing our expectation on the M&A market with essential industry businesses first. So we believe buyers of essential businesses to be viewed as being more recession resistant. We expect strategic buyers who already enjoy strong balance sheets will still consider growth of their business through acquisition and target weaker competitors. Additionally, essential industry businesses will clearly be attractive to financial buyers because it obviously lessens the risk factor of macroeconomic pressures. Most companies in these industries were able to continue operations and may not have to explain dramatic adjustments to their earnings. We expect a different reality, however, among non-essential industries. This is where we believe that there will likely be a shift from strategic buyer-led deals to financial buyers leading the M&A landscape. Over the past several weeks, our phones and email boxes have been ringing off the hooks with calls from private equity investors. They are and have been using the shutdown time to develop acquisition game plans in a market of reduced competition. David previously observed that most M&A transactions are strategic in nature, as strategic buyers can often offer a higher closing price because they believe there will be synergistic cost-saving offsets that a financial acquirer likely cannot match. However, in non-essential industries or in businesses whose earnings have been impacted by the pandemic, we know that strategic buyers will drop off, as the future uncertainty will cause even the most financially strong competitors to reserve capital to keep their existing operations on solid footing. As a result, the coming months represented a competitive opportunity on which financial acquirers hope to capitalize, and we expect them to become very active in M&A activity. One term that we've heard frequently in our discussions with private equity firms is creativity. In order to capitalize on the competitive opportunity that lies ahead, we expect that they will probably be more creative in their deal structures. This may mean that firms that typically invest capital through a combination of their own cash and some bank debt might find affordable debt less available today. As a result, they may have to invest more equity capital or their own cash than normal, or perhaps take minority positions when they usually structure deals in majority positions. Creativity has also been mentioned as a method to address valuation disagreements with sellers who may not agree that their businesses have lost value due to the pandemic economic crisis. So we expect financial buyers to structure offers with future payouts using non-traditional means such as earnouts tied to future performance of your business as they attempt to bridge the valuation gap with you and other sellers. What this all appears to add up to, though, is good news for businesses ready to sell. There will be a market, and with that in mind, David, how should companies be positioning themselves to be first in line when the economy opens up and M&A transactions begin moving forward?
Yeah, real good, Woody. Thanks. Over the past few months, I read some really interesting studies. One article talked about the fact that the majority of baby boomers' wealth is held in 12 million privately owned businesses, of which 70% are expected to change hands in the next 10, 15 years. And surprisingly, 75% of those business owners report that they have no exit plan to transition their ownership when they want to and on their own terms. At the same time, 40% of U.S. businesses are facing a transfer of ownership at any one time. Finally, another article I read was that surprisingly, an average business owner spends 80 hours each year preparing a business plan, but yet when they look at selling their business, they report, and studies have shown, they spend only 6 hours preparing for the transition. So, what should a business owner be doing? Number one, obviously, begin preparing for the sale process as soon as possible so that you're ready to go to market when the timing is right. Two, that should include meeting with advisors who will give you an honest awareness of what your business's strengths and needs are. Third, gain an understanding of what is expected of you and of your company in the sale process. So, Woody, let's perhaps spend a little time wrapping up our presentation today discussing how to prepare for the sale of your business and looking at what a well-run M&A sale process should look like, whether it's in a pandemic environment like we're heading into or a market like we've enjoyed over the last 5 to 10 years. So we talk about planning and preparing. I think a business owner, there are lots of elements that they should think about as they head into planning for the succession of their ownership of their business. I think first, it's ownership dynamics. Not only what's your corporate structure, but governance issues and how your business is operated. If your ownership of your business includes family members, or perhaps might include family members who have an interest in continuing to be involved in the business, I think you need to think about how do you prepare the transition, how should the transition also handle and address family members, conflicting shareholder preferences. If you have multiple shareholders, they may have different ideas on what they want to do post-transaction. They may have different objectives. And, candidly, the COVID environment may have changed everything in the last 2 months. Liquidity and diversification objectives. So I suspect the last few weeks, as we've spent COVID distancing, that may have changed your view of liquidity. So when you start planning for the succession of your ownership, you certainly have to be thinking about taxes associated with the sale of your business. How about pricing? What price are you looking for? If you're going to continue to have some equity ownership in your business, if you end up transitioning your ownership to perhaps a financial buyer, how much equity are you comfortable continuing to own in your business if you sell all or a majority of your business, rather a minority or a majority of your business to a private equity group? And what about leverage? A lot of financial buyers will leverage your business much greater than you do today, so how much leverage will you be comfortable with? Company dynamics. Not only the industry, that you operate in, but also your competitors. Where's your industry in a cycle? Is it heading up or heading down? What about competitors? Debt capacity for your business, leverage tolerance, global threats to your business as well as your industry. And what about opportunities? Management and employee succession. So in the transaction, we find that many business owners like to see their employees rewarded as part of the compensation received when they sell their business. Is that you? What does your management bench look like today? Do you have the depth of management in your business today to continue to grow your business so that when an owner buys your business, do they have to start looking at hiring additional management, replacing management that might be aging? What are the growth prospects for your employees with a new owner? And do you want to create opportunities for them? And finally, timing and risks associated with the transaction. What's the status of capital market support of your industry and your region that you operate in? What's the M&A market for businesses like yours and businesses in your marketplace? What's the prospect of changes in taxes occurring that might affect the earnings of your business, the cash flows of your business, but also the after-tax proceeds when you sell your business? Finally, are you looking at any legislative issues that might change your industry and the profitability of your business? So Woody, once an owner has planned through and thought through these issues and others and come up with goals and objectives in the transaction, what's the process of selling look like? And how have those issues perhaps changed due to the pandemic?
Oh, okay, David. Yeah. So, once you've reached the decision to sell your business, this is where, the fun, quote unquote, begins. I say that facetiously because the sale process is really a lot of work, but it's also an opportunity for you to show off the business that you've built with your own blood, sweat, and tears. When we take companies through this process, we usually tell them to expect the process to take from 6 to 9 months. A well-run sale process should be broken up into 3 stages. First, the pre-market, second, the market, and then finally the close. The pre-market is probably the most time-demanding of the 3 stages on the owner, but we believe it's the stage that most warrants the owner's full attention, as it may be the stage that provides and preserves the greatest value to you as a seller. We often say the owner has 2 jobs in the M&A process: running his company and attending to the requirements of the pre-market stage. This stage leads to a detailed review of the business through the accumulation of necessary documents and records, and evaluation of the company's strengths and weaknesses, and ultimately an expected market valuation and identification of the ideal transaction to meet the owner's goals and objectives. The pre-market stage also includes the development of a marketing strategy and the identification of potential buyers, including both strategic and financial acquirers. The goal of this stage is to construct a comprehensive evaluation of the company, both qualitatively and quantitatively, and identify the appropriate market that is most likely to value the company appropriately. The pre-market stage, when properly executed, will increase the certainty of closing once a buyer is selected and help to avoid retrading should the buyer finalist attempt to negotiate a lower price as the deal moves closer to a close. Now, in response to the COVID-19 crisis, we expect that there will also likely need to be some measurement, documentation, and analysis of the pandemic impacts to the company. The analysis of the crisis should be multidimensional, including not only additional expenses, but also impacts on revenues caused by delays due to vendor or supply chain disruptions, customer orders canceled, or pushed back. Given the importance of this measurement to the valuation discussions you'll have with the buyer in the future, the more detailed, the better, and the more real-time, the better. Document the details now so that you won't have to rely on your crowded memory to produce accurate information supported by detail in the future. Secondly, the market stage. This is where the company gets introduced to target buyers, ultimately leading to offers in the form of letters of intent. The goal of this stage is to cultivate interest among several buyers and orchestrate a competitive bidding process among the targets. This stage is less demanding from the owner's time standpoint, but does include management meetings with interested buyers. And then finally, the close stage. This occurs once the buyer and seller have reached an agreement in principle. A final letter of intent is issued by the buyer. The letter of intent will contain basic deal points and terms, but is non-binding. The actual binding agreement will be the product of the LOI and finer, more inclusive deal points that are the product of considerable negotiating resulting from detailed due diligence by the buyer. The goal of this stage is to avoid negotiations that stray from the original agreement so that the final agreement stays true to the LOI. It's during this stage that both sides benefit from and gain an appreciation for the preparation that went into the pre-market stage. So no surprises in final due diligence results in a more efficient close process, lower legal bills, and less free trade risk. So there you have it. As difficult as the past few weeks have been, there will still be an active market for your business. So as we can sign off and summarize our discussion today, why don't we try to identify some key points, key takeaways for our audience? David, do you want to take that?
Yeah. So Woody, I think like top one ought to be take care of your business, and most importantly, take care of your employees, who are going to be taking care of your clients.
Yeah, and I would also say it's important to know that business will still get done. There will still be deals out there. I remember the old movie Wall Street. The character Gordon Gekko said, "Money never sleeps." So there will be deals still being done. Anything else?
Well said. Well said. There are plenty of eager buyers out in the marketplace. There have been, and there will continue to be, certainly in the future.
Yeah, and if not strategic buyers, then definitely financial buyers.
Absolutely. We know they will definitely be there. I think the final takeaway, begin preparing now, yesterday, and tomorrow for a successful sale and transfer of your ownership of your business. With that, I think we've reached the end of our presentation. Woody, thanks very much for being with me today.
Enjoyed it, David. Thank you.
Yes. Please give us a call or visit our website. This webinar, in addition to being on YouTube, will be posted on our website. You can see our link right here on this page, but it's pcecompanies.com. Thanks for joining us, and we hope we can help you in the future. Thank you.